Are you sick of going to work? Are you ready to retire early? Do you want monthly passive income that will allow you to do whatever you want, to give you the freedom to explore your every whim and desire without ever having to work again? Well, ladies and gentlemen, I present to you the JEPI ETF, also known as the JPMorgan Equity Premium Income ETF. Now, this thing is wildly popular with the passive income community. Number one, because it's actually gone up over the past 5 years, which is pretty incredible for a covered call ETF. And number two, because it seems to have a very, very high yield. So let's do some digging into the JPMorgan Equity Premium Income ETF, JEPI, and I'm going to give you my honest thoughts. So this ETF is very attractive to people because it has a very high dividend yield. As a matter of fact, the last 12 months of rolling dividend yield was 11.29%. Now, you look at the stock market, right? You look at VOO or like any normal ETF, and you're looking at like a 2 or 3% yield at the maximum, right? And they even have a little graphic down here. U.S. equity 1.7, bonds 3.9, et cetera, et cetera. And then you have JEPI here that pays a higher yield than any of these other categories. Isn't this amazing? And on top of that, you get a very, very low expense ratio for an actively managed fund. Now, this is still about, well, more than 10 times more expensive than the Vanguard S&P 500 ETF, VOO, but it's still relatively cheap compared to other actively managed funds out there. On top of that, you have portfolio managers with over 60 years of combined experience. And even better, the best of all, is that you get monthly income. So imagine getting an 11% yield every year with monthly deposits. If you saved $1 million, theoretically, right? If you had $1 million invested in this, you'd be generating what? $112,000 of passive income with $10,000 deposits every single month. Doesn't that sound absolutely amazing? Well, of course, it does sound amazing, but you have to understand what you are investing in when you buy this thing. So what I like to do is read the summary prospectus, because what this does is it gives you a breakdown of exactly what the fund is all about. If you are buying an ETF and you have not read the prospectus and you don't understand what you are reading, you are making a massive mistake. Because if you don't read and know what you're buying, you can get absolutely destroyed because you could be exposing yourself to unnecessary risks. Now, the first thing I like to look at is the management fee. I've already talked about this. This is extremely low for an actively managed fund, but this is an actively managed fund. In the market, there's basically two broad categories of funds. There's actively managed funds and there's passively managed funds. Actively managed funds are where a fund manager is making active decisions to try to usually beat some kind of underlying index. What does that entail? That generally entails more transaction costs because the fund is constantly trading in and out of securities, and a higher turnover ratio. Now we can see portfolio turnover right here may indicate higher transaction costs and may result in higher taxes when shares are held in a taxable account. These costs, which are not reflected in the annual fund operating expenses, affect the fund's performance. During the fund's most recent fiscal year, it had a 195% turnover rate. Now, there's a very specific reason, I think, that this is the case. And it doesn't mean that they're flopping out stocks necessarily hand over fist. But what they are turning over are these very special things called equity-linked notes. Now, before we drive on to that, let's compare JEPI to a passive fund. A passive fund is a fund that just tracks an index. For example, you could buy VOO and it just tracks the S&P 500. There's barely any turnover because they're not really buying or selling securities at a rapid clip. And there's really no active decisions going on there besides making sure that it tracks the index. So you can see that a passive fund, as opposed to JEPI, would have lower transaction costs and lower taxes. JEPI has massively high turnover, like I said, because of these equity-linked notes. Now, I tried to do some research on these things, okay? And these are complicated derivative products. Now, what they do are they are specially designed to combine the economic characteristics of the S&P 500 index with written call options in a single note form and are not traded on an exchange. These things, which the fund can put up to 20% of their net assets in, are actually the reason that they generate a lot of income. These ELNs provide the fund with the vast majority of their income. And they're basically a synthetic, weird, spooky alien combination of the S&P 500 and written call options. A written call option is a contract in which somebody who writes the contract receives a premium, a payment, in exchange for the obligation to sell underlying shares at a specific strike price. So when you go into the world of options, which I don't recommend you do, you can actually sell what's called covered calls. And like I said, you can use that to generate passive income, basically, from a underlying basket of securities. But the risk is that your upside is limited. You sacrifice upside for income. If that's the only thing you need to understand about call options, that is what you are doing when you are writing call options. So if stocks go up a lot, but you have a bunch of written call options, you're probably going to underperform. Now, if we look into the holdings of this ETF, it has about, I would say, maybe 100 stocks and some change. So we go down the list and we can see, okay, Progressive, AbbVie, Hershey, MasterCard, PepsiCo. These are all like legit, well-known companies that are held within this ETF. But these companies are often cycled in and out because the fund managers are saying, oh, we're going to buy this stock and we're going to trim this stock and we're going to increase the allocation of this stock. And oh, we got to pay a little bit of taxes here and a little bit of taxes there. That's what's happening with these stocks. So when you see these companies in here, this could change on the dime. The fund managers could decide to sell Hershey. They could decide to buy more Colgate. They could decide to do whatever they want. That's kind of how it works when you have an active manager. But as you go down the list, you see these equity-linked notes on top of that. These are the notes that we are talking about. So they have some stocks, which gives them some upside potential. And then they also have these complicated, very difficult to understand equity-linked notes that provide the option income. Now, obviously, they're buying these notes from a counterparty. And this counterparty is obviously has something to benefit from this as well. So sometimes JEPI gets a great deal when they buy equity-linked notes, and sometimes they don't get a good deal. It all depends on short-term fluctuations in the market. But at the end of the day, this is a very complicated portfolio. And you have the biggest risk of all, which is that these fund managers right here, who are highly experienced, by the way, look at this, 36 years, 32 years. I'm not saying these guys suck, but what I am saying is if these guys screw up one time, one major mistake, one blow up, you get screwed, okay? So you got to be careful when you buy this stuff. You have to know what you're buying. You're buying a high-yielding ETF. And worst of all, the taxes, okay? JEPI's dividends, 80 to 85%, are taxed as ordinary income. So all that amazing yield that you're getting is getting taxed at your marginal tax bracket, okay? You could be taxed to death. Now, there's basically two types of dividends, ordinary dividends, and then there's qualified dividends. Qualified dividends are taxed at lower rates. Ordinary dividends are taxed at much higher rates. So you're paying a boatload of taxes, okay? You're investing in a bunch of weird equity-linked notes that I don't think anybody really understands besides these fund managers. And you're buying basically a random, constantly shifting basket of underlying stocks. So while it's not the worst thing in the world, you got to understand that when you're buying something like this, you're really buying something that you don't actually understand. So that's kind of my thoughts. I'm staying away from this. I don't care if it has a high yield. I'm not paying a bunch of freaking taxes for no reason.